We've got a very busy week ahead of us in terms of both macroeconomic and company-specific news. Top down, the main feature will be 2019's first meeting of the Federal Open Markets Committee. US Federal Reserve Chairman Jay Powell will announce the American Central Bank's latest policy decision on Wednesday the 30th of January, and there'll be three key features. Watch out for the decision on interest rates. According to the CME's FedWatch tool, which you can follow for free online, markets are putting around a 98% chance on no change, with Powell and colleagues leaving the upper band of the Fed funds rate unchanged at 2.5%. Second, watch out for any guidance on interest rates going forwards for the rest of 2019. Back in December, the Fed talked of 2 or 3 1/4 point rate rises to 3.25% by year end. But wobbly financial markets, mixed economic data and dollar strength, as well as possibly a grumpy president, mean that several Fed officials have backtracked, talking about a possible pause in policy. As a result, CME FedWatch is putting around a 2% chance on 2 rate rises, 20% on 1, 68% on none, and a 10% chance on 1 cut by the end of 2019, as we can see here. Finally, watch out for any comment on the Fed's plan to keep withdrawing quantitative easing at a rate of up to $50 billion a month, or $600 billion a year. Now, Powell's denied that policy is an autopilot, but the quantitative tightening plan still seems preset, and this is important. Since the launch of QE in 2008, financial markets have bathed in over $12 trillion of cheap liquidity provided by the QE schemes of the Fed, Bank of Japan, European Central Bank, Bank of England and Swiss National Bank. But that liquidity is now being withdrawn, and this may go some way to explaining why markets have become more volatile and more choppy over the last 6 to 12 months. Here, by the way, we can see the headline American interest rate and the year-on-year change in the Fed's total asset base in dollars going back to 2008 when QE was first launched by then Fed Chairman Ben S. Bernanke in the autumn. One other macroeconomic number worth watching is on the home front, and that comes out on the 29th of January with the latest mortgage approvals data from the Bank of England. In November, just under 64,000 mortgages were approved, although that was nearly 2% below the November 2017 figure. Worse, that was the 12th year-on-year drop in 14 months. With so much pessimism surrounding the UK economy with regard to how it's doing before Brexit and how it may do afterwards, well, this may be a figure to note, especially for house building and construction-related companies. There are also some intriguing results and trading statements scheduled across a range of UK quoted companies and sectors from the FTSE 100 and the FTSE 250 due in the week ahead. They include Hargreaves Lansdown, former FTSE 100 member Royal Mail and Domino's Pizza on Tuesday the 29th of January, airline Wizz Air and utility Pennon on the 30th, drinks behemoth Diageo, Royal Dutch Shell and Unilever on the 31st, and finally, miner and commodity trader Glencore and embattled telecoms and broadband group TalkTalk on Friday the 1st of February. But for all of those, the name perhaps most capable of causing a fuss in the week ahead is telecoms group BT, which will release its third quarter results on Thursday the 31st of January. As we can see here, the last 12 months have not been too kind to BT's share price. Just as the company was trying to shake off an accounting scandal at an Italian subsidiary, the company then had to scrap plans to grow its dividend by 10% a year last spring. BT also announced 13,000 job cuts as part of a £1.5 billion cost-saving plan, a strategic rethink and, worst of all, a profit warning, and that all proved too much for the company's board and shareholders. Despite reaching an important settlement with the company's pension trustees, which still has, the scheme still has a sizable deficit, Chief Executive Officer Gavin Patterson announced his decision to step down from the job last June, and his successor, Philip Jansen, formerly of WorldPay, he will take the helm on the 1st of February, just after these results. At around 230 pence a share, BT trades no higher now than it did back in 1996, so Jansen's got a pretty big job to do, as Patterson's last set of figures in charge may well suggest. And there'll be 4 key headline numbers that analysts and investors should be looking at. The first is revenues, where BT is currently forecasting a 2% year-on-year drop on an underlying basis for the year. Adjusted sales actually fell 1% year-on-year in the first half. Second number to watch is EBITDA, or earnings before interest, taxes, depreciation and amortisation. Here, BT's thus far forecast a range of 7.3 to 7.4 billion for the full year, marginally down from last year's 7.5 billion, again on an adjusted basis. The third number to watch is what the company calls normalised free cash flow, which BT so far said will fall between 2.3 and 2.5 billion pounds this year. That's quite a way down from 3 billion last year. And the full figure to watch is net debt. This stood at 11.9 billion pounds at the first half stage in September, up by some 2.4 billion from the year before. It's a combination of higher debt and lower cash flow, which has had some investors worrying about BT's dividend and whether the 15.4 pence a share annual distribution could even be cut, let alone just left unchanged. On a 230p share price, an unchanged payout would at least put BT on a dividend yield of 6.6%. Now that might catch the eye of some income seekers, but they will be wanting some extra reassurance on how safe that dividend is, especially once new boss Jansen gets his feet under the table and outlines his plans for the telecoms company. Thank you for watching, and I look forward to seeing you next time.